Your credit score is one of the most important numbers in your financial life, yet many people struggle to improve it even when they do all the right things. Paying bills on time, avoiding overspending, and keeping balances low are just the start. If you're looking for rapid improvement, there are actionable steps you can take to boost your credit score in as little as 30 days. While it's important to remember that long-term financial habits matter most, understanding how credit scoring works and applying strategic tactics can lead to significant short-term gains. Over the past few years, I've researched and tested multiple strategies to accelerate credit score improvement, and I'm going to share the most effective ones in this video. By following this approach, you can see measurable changes within just a month, gain momentum, and lay the foundation for long-term credit health. Even small steps, when implemented correctly and consistently, can result in surprisingly significant improvements in your reported credit metrics. Today, we will talk about how to boost your credit score in 30 days. It works. So, before we start, make sure to hit the like button and subscribe to my channel. The first step to improving your credit score in 30 days is understanding your current credit situation. This involves pulling your credit reports from all three major bureaus: Experian, Equifax, and TransUnion. You are entitled to one free report from each bureau annually via annualcreditreport.com. Carefully review each report for inaccuracies, such as misreported late payments, accounts that don't belong to you, or incorrect balances. Even small errors can prevent your score from rising. Disputing inaccuracies can lead to immediate improvements, sometimes within days, depending on how quickly the bureau corrects the mistake. Beyond errors, reviewing your report allows you to see trends, such as recurring high balances, payment timing issues, or dormant accounts, that you can correct in the short term to maximize your 30-day boost. High credit utilization is another major factor that can suppress your score, and addressing it can have an immediate impact. Credit utilization is the percentage of available credit you're using across all credit cards. Ideally, you want to keep it below 30%, but for optimal improvement, aim for under 10%. If your cards are reporting high balances, pay down amounts before the statement closing date. Timing is critical because credit bureaus report balances as of the statement date, not the payment due date. Paying strategically can instantly lower your reported utilization and result in a noticeable bump in your score. Additionally, you can consider redistributing balances across multiple cards to optimize utilization ratios. For instance, moving part of a high balance from one card to another with a higher limit, but no additional spending, can lower overall utilization and help improve the score reported to the bureaus. Payment history is the single largest component of your credit score, accounting for roughly 35% of most scoring models. If you have missed or late payments, they can significantly hinder your ability to see rapid improvement. The first 30 days of any plan should prioritize catching up on overdue accounts and setting up automatic payments to prevent future late payments. Even one successfully automated payment can stop additional damage and begin to restore trust in your credit profile. Additionally, if you have accounts that are only slightly overdue, paying them off or bringing them current before the reporting cycle can prevent a negative update from being reported at all, which is a simple but often overlooked tactic. Addressing collections accounts or past due medical bills is also crucial. Contacting creditors or collection agencies to negotiate pay-for-delete arrangements or settle balances can remove negative items from your credit report. While these negotiations require persistence and documentation, they can yield fast results. Some creditors report updates within days of resolution, which can positively influence your score quickly. In some cases, even partial payments toward a debt can update your report to show settled instead of unpaid, which can improve your score depending on the scoring model. Opening a new line of credit strategically can also help in certain situations, particularly if you have very limited credit history. A secured credit card or a credit builder loan can add positive information to your report, helping to balance utilization and demonstrate responsible credit use. However, this should be approached cautiously. Applying for multiple new accounts too quickly generates hard inquiries, which can temporarily lower your score. Strategic and measured applications are key to seeing a net gain. Additionally, if you already have open credit cards with low utilization, avoid opening unnecessary accounts, as it can reduce the average account age and slightly offset gains from new positive activity. Be mindful of your credit mix as well. Credit scoring models reward diversity, which means a combination of revolving credit like credit cards and installment loans like auto or personal loans can enhance your score. While it's not realistic to take on unnecessary debt, if you already have multiple account types, ensuring that all are in good standing and up to date can strengthen your overall credit profile in a short period. For example, consistently making payments on an auto loan or small personal loan while keeping credit card balances low demonstrates your ability to manage multiple forms of credit simultaneously. Which scoring models view positively? Another quick win strategy involves increasing your available credit without increasing balances. Requesting a credit limit increase on existing cards can lower your overall utilization ratio if you maintain the same spending habits. Many banks approve reasonable increases without a hard inquiry, which can create an immediate improvement in your reported utilization and overall score. However, it's important not to use the additional credit for new spending, as that would negate the benefit. Even a single limit increase of a few $1,000s can reduce your reported utilization significantly, especially if your balances were previously near the upper limit of a card. Timing and reporting cycles play an important role in short-term improvements. Since credit card issuers report at different times, understanding when your accounts are reported allows you to time payments strategically. Paying down balances just before the statement date, instead of waiting until the due date, ensures that the lower balance is reported to the bureaus, which can create an immediate impact. Monitoring reporting dates across accounts can allow for multiple boosts within a single 30-day window. In addition, making small payments multiple times per month can reduce the average daily balance, which may help lower interest and keep your utilization ratio consistently low. Another factor is managing small, older debts effectively. Even minor unpaid bills or lingering small balances on older accounts can suppress your score. Paying these off, especially if they're close to the threshold for reporting negative information, can remove obstacles and create a noticeable effect on your score. These small victories, while minor individually, cumulatively improve your credit profile. For example, a $75 past due utility bill or an old medical bill could be enough to trigger a negative report, and resolving it can lead to an immediate increase in your score. Avoiding new inquiries or unnecessary applications during this 30-day window is critical. Each hard inquiry can reduce your score temporarily by a few points. By minimizing new credit requests and focusing on improving existing accounts, you ensure that your efforts are not offset by additional downward pressure. If you liked this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.